Good morning, students. A new chapter, depreciation. First of all, you should know what is the meaning of depreciation. Depreciation means fall in the value of assets because of usage, efflux of time, obsolescence, and accident. See, the asset values goes on reducing because we are going on using wear and tear is taking place, time is passing away, and because of that obsolescence, that means old, the machine technology is becoming old, new machine is coming to replace it, and due to accident, the machine values goes on reducing. For overcoming this, so we see that for overcoming this, we need to charge depreciation. Depreciation reduces the book value of fixed assets, and it is a non-cash expense and is a charge against profit. Charge against profit means whether there is a profit or loss, you have to give depreciation. As per our Income Tax Act also, depreciation is needed. It shows the correct net profit and it shows the correct value of fixed assets in the books of accounts. We have done the final accounts. We have seen that in final accounts balance sheet, the correct value of building, plant, furniture, and all other fixed assets can only be given when we subtract depreciation from it. And to get the correct net profit, because we write the depreciation value in the net profit, we close the depreciation in net profit. That's why we get correct net profit even. Then there is the usage, the causes. Why the depreciation is caused? Because we use it. Efflux of time, usage, wear and tear takes place. And because of this wear and tear, we have to charge depreciation. We need to charge depreciation to overcome this wear and tear. Actually, we get a fund by charging depreciation. With that fund, we can buy a new asset also. And we will be able to get a new correct net profit even. Obsolescence means the machine has become out of technology, and that is why depreciation is charged. Objectives: to get correct net profit and to get sufficient fund to replace the obsolete asset. That is the objective of charging depreciation. We have given two points only. There are many more. 2 points because 2 marks, 2 points. Even for 1 mark, you write 2 points only. Now there are 2 methods which is there in our syllabus. Straight line method, which is also known as original cost method, and fixed installment method. All are the same. The names are different, but methods are all same. Fixed installment method. So fixed installment method or this straight line method, original cost method, whatever you say, these are all the methods by which we charge depreciation. This is the straight line method, fixed installment method, or original cost method. Over here, the depreciation value remains same. Over here, the depreciation value remains same. That means if the first year depreciation is 1000, it will remain 1000. Depreciation value doesn't changes with passage of time. But there is one more method that is called written down value method. Under written down value method, the depreciation value goes on reducing. We will understand by doing sums. So don't worry about that. These are just the names you understand. And then when we will do the sums, we will be able to understand these methods of charging depreciation. Next, what are the advantages of straight line method or original cost method? The advantages of these methods are, it is simple. These methods are simple method of calculating depreciation. And the assets can be depreciated up to the zero value. Suppose if I'll give you one example over here, 10,000 is my depreciation, and every year I have to charge depreciation at the rate of 20%, 2,000. So after 5 years, the value of the asset becomes zero. Then there is an advantage of written down value method. This method is accepted under the Income Tax Act. That's the most important advantage. There is an equitable matching of revenue with cost, as higher depreciation is charged in the initial years when the asset is more efficient and productive as compared to the latter years. as compared to the latter years. Now, one more thing I need to add over here, students, is that I'll give you one example over here. Suppose the depreciation is 10%. Now, when I say 10%, suppose the value of the depreciation of the asset is 10,000. So 10% means 1,000 first year. Next year it will be on 9,000. That means 900 in the next year. Next year again it will be on 8,100. That means 810. That means every year I'm subtracting the depreciation and I'm getting the value. On that I am charging depreciation. But under this one, under straight line method, it is not so. Under straight line method, we are directly, every year we are charging depreciation 1,000. Again next year on 10,000 on the original value, 1,000 like that. Some limitations are there of straight line method. The limitations of straight line methods are, we assume that the amount of depreciation is same for all the year is unrealistic, as at the beginning the use of the asset is maximum. So we should charge higher depreciation in the beginning of the years, but we are not. We are charging in same depreciation for the life of the asset. For the entire life of the asset, we are charging same depreciation. And next, the book value of the asset can become zero, although the asset is still usable. That is also one of the disadvantages of or limitations of straight line method. Now let's understand the limitations of diminishing balance method. The value of asset does not become zero. This is one disadvantage. It goes on reducing, but it will not become zero as such. So the machine actual is no more usable, but the value of asset is still in the book. Next, it is difficult task to ascertain the proper rate of depreciation. Whether we will be charging 20%, 10%, 5%, that is very difficult task to assess. It depends on your judgment. There's a difference between straight line method and WBB method. So let's understand the differences. So the differences are depreciation charge. Depreciation is calculated on the original cost of fixed assets. Suppose 10,000, on that 10% depreciation, that means 1,000, and 1,000 remains every year. Depreciation is calculated on the diminishing value. So first year it will remain same, like 10,000 is the value of the asset, 10% is the depreciation, then 1,000. Next year the value becomes 10,000 minus the depreciation value. 10,000 minus the depreciation value of 1,000. That means the value of the asset remains as 9,000. On that you have to charge again 10% depreciation, which is giving me 900. So next year it will become 900. Similarly, in the next year it will become on 8,100. That means 9,000 minus 900. That is giving me 8,100. On this depreciation again, on this depreciation 10%, that is 810. So it goes on diminishing, as we see. It goes on diminishing. First year 1,000, second year 900, third year 810, like that. Amount of depreciation remains same in the straight line, and it goes on diminishing every year in this method, in the diminishing or written down value method or reducing balance method, whatever the name is. So hope you all have understand the theory portion of the depreciation chapter, students. Next, I will be putting up with straight line method. Thank you, students.